First of all, thank you to the organizers for giving us this opportunity to present in the conference. Me and my co-author Samarth Gupta from NCER, so we will be presenting our paper on impact of financial access on gender gap in entrepreneurship and financial inclusion, evidence from India. Samarth is also here with us. So in case you have, have any in between questions, so you can type in the chat box and he will try to respond. Thank you. First of all, uh, sorry, yeah. So there is literature which says that there are inequalities in entrepreneurship in India. So why are those inequalities and what type of inequalities are there? So literature shows that women-owned enterprises, they are found to be less in number, smaller in size of output, sales, employment, and they are found to be concentrated in less efficient and labor-intensive sectors, and they are found to have lower survival rates as compared to male entrepreneurs. And when we study the constraints which are faced by the women enterprises, so here, so one is well-established constraint is that they have less prior work experience and they have lower startup capital, and there are some behavioral factors also which are proven to be as obstacle in the in economic activity pursued by women, and also problems in acquiring financial resources, they are also established as one of the most important barriers that women face in all over the world. So in this context, the research question that we try to answer is that whether bank proximity in rural areas in India at the village level, so whether that improves financial inclusion and entrepreneurship of women in India. So here from financial inclusion, we mean uptake of formal credit at the enterprise level. And here, so why is this question important is because literature also talks about demand and supply side factors, that women have less demand of financial services. So there is no gender discrimination, but actually it is gender gap because of less demand. And also we know that this is important from viewpoint of inclusive development. So we want to see whether when banks are coming closer to villages, whether that actually reduces this constraint, whether there is a higher demand for credit, etc. We study this paper, this question in that light. There can be multiple channels why a bank branch or other forms of credit can impact our economic activity. So one is direct credit channel. People can take credit directly and they can grow in their business enterprises. And there could be indirect channel also. For example, coming establishment of a bank could also strengthen other forms of credit. For example, self-help groups and informal lending also. So there is some evidence of that as well in the literature. And there could also be impact through development of the overall economy, that demand for credit is higher, and there is growth in economic activity pursued by women. And also there is a saving channel. So that having bank closer to your residence or to your place, that also provides you a avenue to put your savings into, so which you can channelize in the future or near future. So for example, Burgess and Pandey, they show that poverty declined because of social banking period. So one reason was that people were able to increase consumption and saving in the over time due to proximity, due to bank development in rural areas. So literature which is very much related to our paper. So we would like to highlight two papers. One is by Bruhan and Love. Though they study establishment of Azteca bank branches in municipalities in Mexico, and they show that when these bank branches came up, these were approximately 800 bank branches which were opened overnight. So they show that this activity actually increased women's income by higher margin, by 9% as compared to men's, which is 4.8%. And they also found that a high portion of women, they were working as wage earners in those municipalities which received this as a bank branch, and lesser proportion of women reported to be unemployed. And similarly, there's another paper by Menon and Rogers. They study social bank period in India in 1970s. They show that this activity of high banking growth in India in rural areas that encouraged women self-employment as own account workers and employers. So I'll go to the data slide. So here you will, for this purpose, the moment we talk about financial access of each village, so we know that not every village has a bank branch. So we use bank directory of commercial bank branches by RBI. So that has approximately 1,54,000 bank branches. And out of these, approximately 52,000 bank branches are in rural areas. And so we can see that not all villages have bank branches, right? So villages which don't have a bank branches, so it is important to measure that, like, how far is the nearest bank branch from those villages. So we do that in this paper. So we define financial access as the distance of each unbanked village from its nearest village and town with bank branch. So for this purpose, as I mentioned, we use RBI directory. And first we map this RBI directory with population census 2011. So we are able to identify unique location of the bank branch. So some villages also have more than one bank branch, so we are able to see that. And we also consider bank branches and offices, because offices can also perform, functions as of a bank branch. So we are able to map approximately 98% of these bank branches with the population census 2011. And then we bring in the GIS data into it. So GIS data, this is provided by World Bank. And so this data gives us, boundary of each village and town in India, in terms of its coordinate latitudes and longitudes. So from there we compute its centroid. And so basically merging these data sets together, we have a village which has a bank, and we have location of that village. So using this, we compute nearest neighbor. We run nearest neighbor algorithm between banked villages and unbanked villages, because we have location of both sets of villages, right? And also because RBI directory has date of opening. So we can see when a bank branch was opened and where it was opened. So using that year, so we are able to compute this distance for each year starting from 1951 onwards to 2019. So there are some limitations of the data. So you can see our working paper on IEG website. So there you will get detailed information about how we prepared this data and what are detailed, limitations. So we have put that in detail. So commercial banks so as I mentioned that this directory is of commercial banks, but we know that there could be multiple channels providing credit, for example cooperative banks, self-help groups, etc. But we do not have their network, at the ground level. So we cannot map that with population census. And there is so then that directly provides you bank branches as on date. It doesn't tell you when which branches were closed and when. So that has implications for the distance that we compute. So for example, um, so when you don't observe whether your nearest branch was closed or not, so in that case your distance to nearest branch will remain same as previous year, until unless a branch opens in a closer neighborhood. So in a sense we do not observe this closure. We see that distance is either remaining the same for villages, or it is declining because of new branches are coming up in the closer neighborhood. And then another limitation is that we do not have exact location of bank branch within a village or town. So we have to work with, location of a village which has a bank branch. Anyways, we consider centroid of that area or that village or town. So in a centroid is a central location of everything in the village. So our concern is mitigated up to some extent. So this is a screenshot of the data. Here you see that, sorry. So here you see that, so this average distance in figure 1, so we plot it from 1951 onwards. So you see this is plotted for all unbanked villages, okay, as of 2019. And you see that this has declined from approximately 43 kilometers in 1951 to around 4.2 kilometers in 2019. And then in next graph, we study the population group of the nearest bank branch. So basically we study whether whether your nearest branch was in rural area or urban area or metropolitan area, so here you see that in 1951, so the highest share was of urban area. I mean, for all unbanked villages, majority of them, the nearest branch was in urban area, and this has changed over time. So now for 88% of the villages, their nearest branch falls in rural area itself. Okay, and the next share is of semi-urban area. So we can see that there has been a large development of bank branch network, and the proximity has improved substantially, and therefore financial inclusion from supply side, that has improved. And then we use economic census data, because we are talking about economic activity pursued by women at the village level. So we use 4 rounds of economic census. There are 6 rounds of this in total, and so this has limited set of indicators. So this provides information on financial uptake of formal credit. So this is enumeration of all enterprises at the rural at the village level, and it does not include traditional agricultural practices. It doesn't include gambling, NGO type of activities. And so we see that so we have indicators on, what is your major source of finance, whether it is from a bank, from government subsidies, from self-help groups, and a few others, like from friends and family. So we can classify those in formal and informal. So the one problem is that it doesn't have self-help group access to credit, throughout the census period. So it is only available as separate option in the latest round 2013. So and then we use, number of enterprises, male and female, because we have gender of the owner. We also have we can classify that in agriculture versus non-agriculture sector. And then we have size of employment, so of each enterprise. So we these are the sort of outcome variables that we use in our data. And then after that, because now the question is that we have to combine population census and our financial access data, and also economic census data. So for that purpose, we use shrug IDs prepared by Sam Asher and his team. So we using these shrug IDs, we are able to form a panel of all villages. So this is the summary stat in brief. So you use it. So this is these numbers are average per village. Okay, so you see that here, that there has been growth, substantial growth in number of enterprises, both in female and male owned enterprises. So female owned enterprises have increased up to six enterprises per village, and the male enterprises have grown up to 33 per village. And in terms of access to finance, it remains low. Its presence is lower, but it has grown over time. And specifically when we see informal finance, sorry, there is some, okay. So when we see informal finance, we see that it has come down for for males. It has come down from up to 0.251. So similarly, we also see some declining trend for formal finance for male in owned enterprises. It has come down from 1.27 to 0.98. And when we see the enterprises in agriculture and non-agriculture sector, so we see that the size of the non-agriculture sector is larger, but there is not much difference when we talk about females, but there is some difference in case of male owned enterprises. And we also see that there are sharp gender gap here. And when we see the size of the employment, so here, we do not have any direct indicator to measure the output of the firm. So we consider employment as that indicator. So you see that employment, again, it is high in non-agriculture sector, and but again there are significant gender gap here. So when it comes to banking sector, so it is important to know different policies pursued by RBI over time. So we are aware of social banking period starting from 1969 to 1990. So this was very significant period when it comes to banking growth in India. So there were quota systems introduced, and national 14 banks were nationalized in 1969. And so this quota system basically required banks to open three branches in rural areas if they open one bank branch in urban area. So this is one reason that why we saw a sharp increase in rural bank branch network, so indicated by blue bars here. And so this requirement was increased to 4:1 after some time, in somewhere sometime in 70s. And when this quota system ended in 1990, so you see that there is a sharp jump in the establishment of bank branches. So it is only we hardly see any growth in rural areas. So it again followed sort of like demand side model. So RBI realized that okay, bank branches are not coming in rural areas. So in 2005 they issued they implemented another branch authorization policy in a more liberalized manner. So they provided more flexibility in opening of bank branches to banks in rural areas as well as in urban areas. And there was fast approval of annual bank branch expansion. And they also removed service area approach in 2004 and 2000, sometime between 2004 and 2005. So this service area approach was issued in 1989. So this required sort of like targeting based lending. So because the coverage of banking sector was lower in rural areas, so RBI, what it did is they assigned like 15 to 25 villages per bank branch. So that branch was supposed to take care of credit needs of those villages. And if so, that was called service area branch for those villages. So if people wanted to move to go to another branch outside their service area, so it was difficult. In a sense, they were supposed to produce a no due certificate from their service area branch. So it actually impacted the flexibility, gave them less choice to the consumers to access bank branches. So this was also removed near to 2005. So in a sense, this also expanded market to the banking industry. So they had larger options to access the market, to attract consumers from different areas. And also consumers had more flexibility. So therefore we see that after 2005 there is a significant jump in urban as well as in rural bank branches in the country. Yeah, so this is important for our paper because we study period before 2005 and after 2005. Yeah, so how a rural contours of economic activity are changing due to bank branches expansion. So our contribution, as we have said that we are working at the village level and we are able to cover all villages. So this is a comprehensive study, and we are able to study the whole economy, not just few sample villages or so. So identification strategy. So we are aware that there are issues. For example, bank branch could move to areas with high demand even after 2005. And there were some other similar programs which were issued at the same time, like rural roads program and Narega, and many other some other policies towards rural economic activity. So for to tackle this, we actually use difference in difference estimation technique. And for this we define two groups of villages. One is control group of villages, where are those unbanked villages which did not have a bank branch within 5 kilometer up to 2013. So where our analysis ends. So their nearest bank branch was greater than 5 kilometers. Okay. And treatment group are those villages, those unbanked villages, where nearest branch was within 5 kilometer up to 2000. Sorry, it was more than 5 kilometers up to 2005, but the distance declined within 5 kilometers from 2006 to 2013. So these are two groups, and if you can see the size of the group. So treatment group is approximately 74,000 villages we have in our data, and control group it is almost double. So more than double, 1,87,000 villages in control group. And this is very commonly used econometric specification, where we have treated dummy. It takes value 1 for treated villages, and post treatment it takes value 1 for post treatment, I mean after 2005. And then there is interaction term, which takes value 1 for treated villages after 2005. So this gives us average treatment impact. And we also use well, a slightly improved specification, where we control for village and year specific dummies in the data. So results. So before we go to results, I would like to mention that we have some additional results in the PPT as compared to the paper. So I will highlight accordingly when I reach there. So first of all, this is a simple correlation plot of formal credit and distance to banks. So you can see that this is declining. So as distance is rising for each village, so number of firms with formal credit, okay, that is declining. So we see that the distance has some role to play here in the economic activity and also in access to credit. So this is the result on formal finance, including SHG. So this was a result in our paper, and we plot the DID graphs here, and as you see that number of female-owned enterprises with formal credit, that increases significantly in both villages, treated and control group of villages. But we see that there is additional increase in the treated group, and this increases approximately 50% of the mean. And in case of male enterprises, we do not see any impact here in when it comes to formal access to formal credit. But in so yeah, so when we exclude self-help groups, extent of as self-help groups as major source of finance is approximately 20% in the data. Okay, so when we exclude that from the data, so we see that there is no increase in female owned enterprises with the formal finance excluding SHG. Excuse me. Yeah, there is no impact in yeah, excluding SHGs. And so this interaction coefficient is 0.005, which is insignificant. And but when we see males access to formal finance without SHG, we see that it is declining in both type of villages. And we do not see any impact. I mean, so this indicates that if credit uptake from a formal banks is not increases, so that there might be some other forms of credit that might be getting stronger. So for example, from previous we see that there is no decline in male owned enterprises with formal finance because we have here SHG access involved here. So it indicates that probably with closer, as banks are coming closer, self-help groups are also becoming more stronger, more strengthened to provide credit in the rural areas. So this is informal finance. So what happens to it when banks are coming closer? So for women, we do not see we see some impact, that because interaction coefficient is positive, we see that impact from informal lending increases among female owned enterprises. But here the assumption of parallel trends doesn't meet, so we cannot see whether it is due to banks or so. And when it comes to male owned enterprises, we see that informal finance is declining in both type of villages after 2005, but decline in treated villages seems to be lower as compared to control group villages. So here also we can see that probably informal lending has some role to play as well. So as banks are coming closer, the people I mean in informal business could be borrowing more from the banks and then lending to people in rural areas. So this is what we see here, that other forms of credit are becoming more could be playing a role, not a direct bank credit. And when we come to treatment effect on entrepreneurship, so here we study the number of enterprises, female owned and male owned enterprises. So here you see that in villages which are coming closer to banks, I mean for one treated village, we see that the number of female owned firms is increasing more in treated villages. So the impact is approximately 0.605. This is the coefficient of interaction term. And when we compute the value of this coefficient, so we see that this is approximately equal to 15% of the mean of this indicator. So we see that villages which are coming closer to banks, so their female owned enterprises, it is increasing significantly. Okay, and when we come to male owned enterprises, we do not observe any significant impact in treated villages. I mean, there is no additional gain in treated villages, although we see that after 2005 curve is increasing. It is increasing in both type of villages. And yeah, so after that we divide our industries, sorry, not industries, enterprises, into agriculture and non-agriculture sector. So here you will be able to see that in agriculture sector we do not uh, so what we see is that there is increase in agriculture sector, in agriculture enterprises. For male owned enterprises, we see that there is the increase is small. As we see that the slope of the black curve is not as steep as in control group of villages, but for female owned enterprises we do not find any significant impact. Okay, so what we see is that those villages where banks are coming closer, the agriculture sector is expanding, but it is expanding by smaller size. So that is why the interaction term here is negative, which is minus 0.96. Yeah, and the assumption of parallel trends hold here as well. And when we study the non-agriculture sector, here you see that activity for both male and female that increases after 2005. But we see that there is the increase for females is much sharper, and when we compare it with control group, so this impact is 0.54 for one treated village. Okay, and for males we see that this coefficient is 1.007. So although this coefficient is higher, but when we compare this coefficient with the mean of this indicator, we see that the impact for female owned firms is much higher. It is approximately 25% as compared to 4.5% for male owned firms. So we observe that so we can see some sort of structural shift, which is in favor of non agriculture sector in those villages which are coming closer to banks. Okay, after 2005. Yeah. And then we study the size of employment. So this is employment in agriculture sector. We see that employment in these sectors has increased in agriculture sector for both male and female labor force. But we see that the rise in treated villages is smaller in for the both groups. So in a sense that agriculture enterprises, they are growing, but they are growing at a slower rate in treated villages. So this is the picture these two diagrams are showing here for employment. And when we see non-agriculture sector, so we can observe that the impact is much higher. So female employment in non-agriculture sector, you see that for one village, so additional 5.5 yeah, females are getting employed in non-agriculture sector, and this impact is approximately 39% of the mean of this indicator. And assumption of parallel trends is also holding here. And for males, we saw a very high and very significant impact, and assumption of parallel trends is meeting, but the size of the impact is somewhere around 7.9% of mean of this indicator. So from these graphs, we do see that although agriculture sector and non-agriculture both are growing, agriculture sector is growing at a smaller size, but there is large increase in the non-agriculture sector for
Sandhya,
yeah.
you just have now 5 to 6 minutes, 5 minutes more to wrap
Sure,
up.
ma'am. Sure,
Yeah,
ma'am.
yeah.
So right now we have seen that what is the impact for one treated village. So when we actually see bank branch expansion, we can observe that uh, when a bank branch is established, it can cover more than one village within 5 kilometer. So we compute that and we find that one bank branch can cover 9 unbanked villages within 5 kilometer. Okay, on an average. So what we do is we compute our analysis for this magnitude. So we multiply the computed coefficients with this number 9.04. So here again you see that total enterprises for female owned enterprises, these are increasing, and these are increasing more in non-agriculture sector, right? So similarly employment in non-agriculture sector is also higher. So looking at these numbers, we see that the gender gap in entrepreneurship and also in employment, that is actually getting reduced. But we do not find direct impact of bank credit. It could be possible that indirect channels, there could be saving channel that could be operating, or other forms of credit are getting strengthened. So robustness checks, we check that other infrastructure indicators which could drive these results. So for example, roads, we collate this data from census, population census itself for two rounds, 2001 and 2011. So we see that our so the availability of roads is converging between both type of villages. So in a sense, our control group has higher roads. So and cooperative banks and agriculture credit societies, so we are treated and control group, they are not different. So we are able to say that our results are not driven by these indicators, and we were trying to isolate the impact of banks, right? So banks, so what is the impact? So we were able to achieve that. And so this is a conclusion. As I said, we do not find any direct impact of credit channel. So there is some evidence of indirect channel, that informal lending is strengthening, and also self-help groups are getting strengthened. And we see that relative impact on women is higher, both in entrepreneurship and also in employment. So in non-agriculture sector. So and we also saw that the shift is actually taking place from agriculture to non-agriculture sector. Yeah, so we can see that if there is a development in the financial side, so that can reduce the barriers for access to finance for women, and that can lead to structural transformation in the economy. Yeah, thank you. So we are ready to take questions. Thank you.
Thanks so much. Thank you so much, Sandhya. Sujata, I'll just invite you now to give your comments on the paper.
So I'll just stop sharing my screen, right?
Sure. Yeah, please, if you could.
Yeah, done. Thank you.
Okay. Can everybody hear me?
Yes, very clearly. Very clearly.
Okay, great, great. So I'm going to share my slides. I hope you can see them now. Can you see my slides? I just have to check.
Yes, yes, very clearly.
Okay, okay, great. Okay, so thank you very much for inviting me to do this discussion. I read the paper with a lot of interest and I enjoyed reading it. So I'd like to thank the authors for that. I'm going to keep my comments. I'm not going to talk about every little thing. It's not like a referee report for a journal, but I'm going to highlight the major things that I think it might be helpful for the authors to think about. So just a very quick recap or summary about what the authors are doing here. Clearly, we know that women are less likely to be entrepreneurs, and their data also shows that women in India are less likely to use formal finance, even if they are running an enterprise. And the question that they're asking is, could this be due to lack of access to financial services, in particular, lack of access to banking services? Could it be that this lack of access affects women more than it affects men? And they're using, as you saw, a differences in differences strategy to estimate the effect of access to banking services. So they're relying on the fact that in 2005, the RBI loosened the barriers to opening new bank branches. I think somebody in the comments, I wasn't really reading the chat, but I saw something pop up on my screen that said, why is there an inflection point in 2005? And that's exactly why 2005 is so important here, because that's when the barriers to setting up new branches were loosened in and she explained, Sandhya explained in a lot of detail what exactly the policy changes were. But from the point of view of this paper, the purpose, the reason for thinking about that is that suddenly you can start seeing new branches opening. And so more villages begin to be served by banks. And what they're doing in their analysis is they are calculating a dummy variable, which is what I've written here, an indicator for whether a new branch was open within 5 kilometers of a village during this time period between 2006 and 2013. Now, the important thing, and I read both the paper that they submitted to the workshop, but also the companion paper that they have, which is all about how they calculate this variable. And my understanding is that they're only focusing, all of their analysis in this paper is only on those villages that remain unbanked throughout the sample period. So as of 31st October 2019, if you still did not have a bank branch, then you are in the sample here. And then for that unbanked village, they're measuring the distance using this nearest neighbor algorithm um, to the nearest banked village. And if that distance to the nearest banked village is smaller than 5 kilometers, then you're called treated. And if it's longer than, if it's further away than 5 kilometers, then you're called untreated. So it's important to understand, I think, how exactly this has been done. And I'll have something more to say about this at the end. And then it's just a standard differences in differences strategy. So treated is if you do have a village, if you do have a bank within 5 kilometers, and then this dummy variable post-treatment is about whether we're measuring you after 2005, and then the interaction, obviously. Now, clearly in this differences in differences strategy, all of the effects are being estimated off of the term that's in the parentheses. And so this varies at the village interacted with year level. So any controls that also vary at the village times year level will obviously be collinear with that term, and so cannot be included in this regression, right? So this is a bit of a challenge because it means that it's difficult for them to rule out any other changes that are taking place in these villages at the same time, or actually, and when I say at the same time, it's really anything that happens after 2005, which is also when this bank variable is changing. Now, obviously, this is a standard issue in any differences in differences strategy. Whatever level at which your explanatory variable is varying, you cannot control for anything else that might be happening at the same time, right? So clearly they have thought about this, and you must have seen this in the slides, that for every graph that she showed, she had a little note below it saying whether it passed the parallel trend test or not. So they check that for every single variable. And the other thing that they do, I'll talk about that. Let me get to the second point later. But I think it's important to understand that parallel trends do not prove that the effects are well identified, right? If the way to think about parallel trends and differences is if you don't have parallel trends, then you definitely know you're in trouble, that this differences in differences estimate is not identified. But just because you have parallel trends doesn't prove that your effects are well identified, because even with parallel trends, you cannot, you have to try and convince the reader or the audience that there's nothing else that could have or should have changed at the same time in these villages that got the banks at the time that they got the banks, or they got a bank within 5 kilometers, right? And they do check for that as well. So they do check if there are similar breaks. She told us about this also in other potentially confounding variables such as cooperative banks and agricultural credit societies. But you could get a skeptical reader who might say maybe these are bad proxies for changing factors that drive entrepreneurship, right? Maybe most entrepreneurs are not actually borrowing from cooperatives or from agricultural credit societies. So I think there has been thought given to this problem that their differences in differences strategy is potentially subject to, and they have tried to do that. But I would suggest that it would be much better for them if they could use exogenous variation in access to banking. So the piece that's missing here is that the banks, when they were set up, we don't think that there were any rules necessarily exogenous to demand or supply that drove where the banks came up, right? So that's the part, that's the exogeneity that we would hope for, that they don't have at the moment. And so just thinking about this, the very first thing that came to my mind, and given the fact that they haven't done it, I'm wondering if there's something very obvious, an obvious reason why they haven't done that, that I have completely missed. But my understanding is that, this is what I think could be done. So in their paper, access is, as I said, defined as having a bank within 5 kilometers of your village, of your unbanked village, and it's measured just by Euclidean distance, right? So it's literally, I suppose, as the crow would fly, is there another village within 5 kilometers that has a bank? Another location within 5 kilometers that has the bank. But I mean, most of us don't travel the way the crow flies, right? So true access to a bank must depend on the ability to get to the bank. And that's where I think that paved roads can play a very important role. And we know that the Pradhan Mantri Gram Sadak Yojana was rolled out starting in 2000 or 2001. And lots of papers, I have listed 3 here, have used the Gram Sadak Yojana for the fact that there was exogenous variation in which villages got the sadaks, got the streets first, got the roads first, as opposed to later. And so I'm wondering if they could use this as, think of access to a bank a little bit differently from Euclidean distance, but then use the fact that you get more access if you have a road connecting you to that bank, and use the exogeneity of the construction of those roads to actually improve their identification strategy. The other question that I had for them is this. So once I read the paper, I realized that their entire sample is only focusing on banks that even in 2019 do not have a branch inside them. And so that's a very selected sample. And it's only actually, interestingly, 49% of all the villages that they have data for in the economic census. So what I haven't quite understood is why wouldn't they use the universe of all villages and then even using their own differences strategy, use an indicator for the year when a bank arrives within the 5 kilometers, because then they'd be able to use much more of their data. And we wouldn't have this concern about external validity, which is, why are we only talking about the effects on entrepreneurship or access to finance in these very special villages that as of 2019, even no bank has gone and opened a branch in. And then I think this is possibly the next thing. Yes. So the other thing I haven't understood, because I did go back to Garg and Gupta, that's a typo, 2020, to look at how they constructed their distance variables. And I saw that they said there that there are almost 6 lakh unbanked villages as of 31st of October. But in this paper, their sample seems to only be 2.6 lakhs. So I couldn't understand where that difference came from. And then the last point I wanted to make was, I think the most interesting question here is, what are the mechanisms, right? Why is there a gender gap in entrepreneurship and the use of formal finance? And when we talk about that, you can think of many, many reasons. I mean, it's just a very long list and complex list of reasons why women might not be entrepreneurs as often as men are. Obviously, education, the fact that their opportunity cost of time is higher, possibly. They might have worse entrepreneurial skills, they might be more risk averse, they might have lower confidence. And of course, everything that we know about women all over the world even, is that they might face more social constraints. So I do understand that their data do not allow them to test for any of this directly, because in the economic census, I don't think they have that sort of data. Now, one option would be to augment this data with other data sets, which might give them better information. But the other thing they could do even with their data is check whether the outcomes vary according to other characteristics of villages, right? So if they did heterogeneity analysis, they would be able to tell us if villages where there's more female education that are closer to cities, where there's greater labor force participation, do we see the outcomes improve by more? But overall, I would say this is a very important question. Understanding why there are barriers to female entrepreneurship is very important. And if we can get a better handle on understanding why they exist, then I think this can be truly impactful and could inform policy. So once again, I enjoyed reading the paper, and thank you for the opportunity.
Thanks so much, Sujata, and those are very useful and constructive comments. I think, Sandhya, Samarth, you've been reading some of the comments that have been coming up. Any responses to those comments, as well as Sujata's comments as well? We just have about 4 minutes to wrapping up.
Yeah. So thanks, Dr. Sujata, for your comments. And could you please share your PPT with us? It will be very useful.
Sure.
So yeah. And regarding this, why we are not including all set of villages. So basically, we exclude those villages whose distance to bank remains more than 5 kilometer up to 2013 itself. And I mean, so that part is excluded from the analysis. So that's why we have, almost like 50 60% of villages in our analysis. And when you said that access to banks can be, we can understand using roads data, so that will just give us whether, village itself has a road or not, and whether village with bank has a road or not, but we cannot actually see whether those, roads are connected to each other. So for that we will need spatial data of roads. I think that may not be possible, but we do have bank roads data from census itself as well for 2001 and 2011. So this is very close to our analysis periods, but we will definitely try to have the gram sadak yojana data as well into the picture. And we will also try to incorporate see how to incorporate rest of the comments. So if Samarth has to say something, Samarth is there. Yeah, thank you.
Oh, just not much, but thank you, Dr. Sujata. The comment on 5 kilometers is the Euclidean distance, and it may not be the same as ability to access it. So we were aware of that, and in the previous paper, which is at IEG now, we actually discussed that the Euclidean distance and the actual distance are actually very correlated. Some other studies have actually uh, drafted this and computed this, that so in some ways Euclidean distance can be a good proxy for how much time it actually takes, especially in the plains. Only exceptions come when you're talking about mountainous hilly regions. That's one thing. Second, I think Sandhya made one single error in her reply, that why are we only observing 2.62 lakh villages, because we exclude those villages which already had a bank within 5 kilometers, 98.
Oh
So there
yes,
was a
yes,
big,
sorry.
they could be unbanked, but there was a big mass which already were treated by our definition in 98. So in that sense, we are excluding that. And you're right, we can play around with our groups, but and finally the point on mechanism, I think we believe the mechanisms are basically mobility constraints, that women, there are constraints on women to go out, go far away, and men don't have that constraint. So when a bank comes nearby, it's easier for them to access that. So and we don't have those results in the presentation, but we have done an analysis at 3 kilometer to find that the credit uptake results are actually at least stronger. So that shows us that the mechanism exactly is the not exactly, but to some extent is the mobility constraint. The heterogeneity analysis, yeah, we'll have to look into that. I mean, there are many things that many ways we can try to cut the data, but we'll look into that as well. Thank you.